Hey, and welcome back to Happy Investors. In this edition, we're going to talk about interesting high dividend stocks, companies that pay out more than 5 or 6% in dividends. And high dividend stocks can be interesting for people who, for example, want to enjoy retirement or seek a bit more security. And of course, there are also downsides to high dividend stocks. But in this video, for inspiration, 7 high dividend stocks that are likely to perform well in the next 6 to 12 months. Also, paying out high dividends. Why are we sharing this? For inspiration-free videos. Because we at Happy Investors have access to many data sources. We're spending more than €7,000 a year. Not that it's shocking, but a lot of people don't have access to that. So, we love to share free inspiration and content through our channel. Because if we give you good tips, you'll be happy with Happy Investors. That's really the essence of Happy Investors. And of course, a bit of reputation also for myself, but also just to help you. And that fits me perfectly. Works out well, it's a win-win situation. Just keep in mind, this is purely for inspiration. We're showing a number of stocks, those that score high within our methodology and investment tools. After the research is really necessary. Do you really want higher quality? Take a look at our website. We select every month a potentially great growth stock, dividend stock, and also a value stock. But that's a paid service. However, it's only €99 per year, so you don't have to lose sleep over that. And the big distinction is we've done a lot more research on that to the company from here. So a lot more fundamental analysis, but these videos are free. For inspiration, 7 high dividend stocks. I'm really curious to hear what you think about it. Do pay attention to the pros and cons of these types of companies, and they don't pay out high dividends for nothing. So always think carefully before you get into that. I'm curious to hear what you think about it. Let me know in the comments. Do you have any other high dividend stocks in mind? Let me know. Perhaps I can check in our screeners how they're doing. Get started. We've mentioned EPR Properties before as an interesting dividend stock, and it pays a high dividend, namely around 7%. EPR is a specialized real estate fund, so take a good look at what they do, such as theaters, but also some amusement parks and other things like fitness, for example. Now, specialized real estate funds can potentially achieve high returns thanks to a specialized strategy, but they can also carry a bit more risk. The fair value estimate from Morningstar is $47. The highest price is $46, so it's around the fair value. And we're going to see what this stock might have some price potential. Analysts expect a higher price. Consider historical valuation. They believe that the price could turn out to be a bit higher. Look at the historical valuation. Waste to price is below fair value. Waste falls below fair value. That's the orange line. It lies below the fair value line. That's the orange line as we can see here on the screen. Why is that favorable? Well, because they can, of course, with certain profit growth, they can achieve a high return. Let's assume a normal valuation of around that price. Waste of 10, that is in line with the current price drop. Then, because the price is already relatively low, can they achieve a return of about 11% per year, including dividends? It's not earth-shattering, all of it. But what do you expect from high dividends? Stocks? The most important thing is that they pay a stable dividend, because that's obviously the strategy for high dividend stocks. Looking at the valuation of this fund, then it's relatively cheap compared to the sector. Median, so that's always relatively favorable. Let's look at the dividend yield. For next year, it's estimated to be around 7.3%. The payout ratio is 70%. And in terms of dividend growth, they don't perform that well. Superior, that's 2 years in a row. And the number of consecutive payments is only 2 years. There was a disruption in 2021. In the past, they always paid out dividends. The fund has been affected also by the coronavirus crisis, but it seems to be heading in the right direction again. Zyxstrength gives a hold rating. And let's look at the technical analysis. And then we see, hey, a buy signal at this moment. It has to do with the long-term trends that cross each other, and that gives a positive buy signal. We also see that the MACD is starting to turn positive below, and the statistics are also starting to rise. Real estate funds have recently dropped a bit. EPR might break through to a slightly higher level. The last short-term barrier is about plus 4%. But of course, we hope that if you invest in this, that it goes back to the all-time high. If that were to happen, of course, only based on fundamental developments, or maybe an interest rate decision, then the upside potential could be high, namely 70%. However, note, this is purely technical analysis, and we need to look at the valuation in combination with the growth. And then an 11% per year seems more realistic. And I'll always keep in mind the downside scenarios that it could turn out negatively. The company Energy Transfer with the ticker EET might just provide interesting dividends and returns. Now, President Trump has made a number of changes. And of course, Trump is known for not being very sustainable to consume energy. So For a company like Energy Transfer, which is known for its energy consumption, oil companies can also benefit from this. According to Morningstar, 3 stars with a fair value estimate of 21. Well, that's actually the same price as the current share price. And analysts expect that in the short term, the stock could rise a bit further with an upside potential of 20%, or 10%, or at least 5%. Now, you shouldn't have very high price expectations from high dividend stocks. However, it seems that Energy Transfer might actually achieve high returns. If we look at the historical valuation, it seems that the stock might be undervalued. However, that is, of course, based on the growth expectations. Are we looking at the EPS estimates from Analista, as we see below, and we see the normal multiple of 10? Maybe we should use a different multiple here. However, that is, of course, a bit of uncertainty. Why would you maintain a different, higher price-to-earnings expectation? Yes, simply because with Trump done, the power could be very good for gas and oil in the coming 4 years. So maybe keeping a multiple of 10 is too low. Let's say it's a multiple of 15, then Energy Transfer. They could still achieve a decent return of about 8% per year. There might be other better high dividend stocks. Definitely, after watching this video, looking at the factor analysis, that's positive. Everything actually seems to be giving a green signal. That's usually good. The current price to earnings ratio seems a bit on the high side. Also for next year, 47 is not very low. Definitely not compared to the sector median. We must explore why this company is poised for success. Tougher than the sector median, luck ratio under 1. It's harder to achieve than the sector median. With a luck ratio below 1, which is usually just favorable, the company is on the larger side, namely 70 billion. However, it does have $60 billion in assets. Of course, also a capital-intensive business. Keep that in mind. The current dividend yield is 6%. However, the average over 5 years was 9%, so we definitely have a high dividend there. But note that the payout ratio is 93%, and actually you'd prefer to have a stock with a payout ratio below 70%. Why? That provides a bit more safety and security, because the company then invests more in its own growth. For 3 years in a row, they have achieved dividend growth, and they have been paying out dividends for 18 consecutive years. Indeed, sometimes with a dip, as you can see. Energy Transfer is a hold for Zexrank, and regarding technical analysis, we see that there, yes, what can we say? The only thing we can establish is that there is a strong momentum. The possible, psychological, the barrier was a price level of around 20, and it seems to be breaking out above that now. Suppose the reason is to keep going until the last all-time high. That's still about 50% upside potential. And we can, of course, also turn it around. Look, about 60% upside potential. I'm not sure if it will really make it with Trump's arrival. No one knows for sure, and that makes it a bit riskier. But a high dividend is definitely paid out, and it seems that it could still be the case for the coming years. Overall, I do think there are better, safer options than Energy Transfer. But precisely because there is more uncertainty involved here, such stock can exceed our expectations. Western Midstream Partners is also a high dividend stock with the ticker WES. Now, the current price is 42. However, Morningstar gives a fair value of 33 and 2 stars. It does indicate that it has a small economic moat. Now, Western Midstream Partners is active in oil and gas. This is actually the same thesis as for Energy Transfers. Namely, Trump is going to stimulate oil and gas more. It could turn out positively, but there is more uncertainty here. Analysts also think that the price might have risen a bit too high. If we really look from the other angle, namely historical valuation and in relation to the EPS growth, then it could indeed show some upside potential. You can see that the price is well below the normal multiple and the fair value line. Even when we zoom in on 7 years, we actually see that it still lies below the fair value line. What does that mean? However, let's use the normal multiple for safety. That's 11, P/E ratio of 11. And the EPS estimates are actually a relatively small growth, or even a small loss. Well, the current price isn't very high with a price to earnings ratio of 10, so that could mean an average total return of 9%, including dividends. The brain is actually very high. Dividend out. Now, this valuation looks a bit like a buy. Price to earnings of 10 for next year. The price to earnings ratio of 1.4. It's really not favorable. So in relation to growth, it's a bit less favorable. We also see that, for example, the price to book ratio is quite high. So I'm less enthusiastic about this, but a specified number nonetheless, because it could surprise due to the turn in America, of course, for oil and gas, Do keep an eye on the higher debts, of course. A capital-intensive company, so also pay attention to the depreciation and the cash flow, especially the free cash flow is important here. The dividend yield for next year is estimated at 8.3%, with a very high payout ratio of 81%. This doesn't expect too much growth. This may be a short-term, an investment for those who want to enjoy an 8% dividend. But pay attention to the dividend history, which actually looked good all the time. There has indeed been a significant decline since 2020. We might all know why. And it's starting to rise significantly again. They've been paying dividends for 11 years in a row, dividend out, even in the difficult year of the coronavirus crisis, and dividend growth for 3 years in a row. So from a dividend perspective regarding its dividend, and they do pay out regularly, and trying to achieve dividend growth, it all seems a bit more positive. However, Zexcheng indicates, well, they are less positive about it. We actually don't have a detailed analysis. The relationship is then very quickly over. Look at technical analysis. What we see here at the bottom is that the MACD has crossed again, which is positive, and that the momentum is starting to pick up a bit again. This last peak here is at the same price level. He's been doing quite well lately. Well, this stock has risen a lot. With about 70%, that's obviously a lot for a high dividend stock. It would be nice if it dropped back to this level in the short term. Here, then we see a drop of about 15% to a price level of 35. And if it stabilizes again and goes up, that would at least give it a more attractive value. Can the price rise further? Well, if momentum increases, this becomes a strong buy, I can assure you, for example, in these algorithms that we see here. And the price can then break through to another historical high, but that's purely based on technical analysis. In terms of fundamental analysis, the stock does seem to be a bit relatively, or a bit cheaper. But I really wonder what the long-term prospects of this company are, and also what the impact of Trump is on this company and its dividend, of course. The company Amcor, with the ticker AMCR, is a more complex case and therefore only suitable for advanced investors. This is a potential high dividend stock with a high price return. However, much more research needs to be done on this. Personally, I don't know the company either. However, I noticed it after the hike, of course, every day. A lot of stocks, screening, hundreds, thousands, I don't know anymore. Amcor has sold 50% to a party, so there's a lot going on here. They also have relatively a lot of debt, so keep that in mind. So real research needs to be done here, but that can actually lead to potentially high returns, because we naturally get scared off by uncertainty. However, if you know more than the company and you know more than the market, then uncertainty is a relative concept. The current price has recently dropped a lot to a price level of around 13, and you can also see that it's below the fair value line. That means below the intrinsic value, at least according to this model. So research is needed for that. Analysts are providing estimates, in total 14, 11, with an EPS growth of around 5%, so not extremely high. Then a price to earnings ratio would be more suitable, around 15. That means a potential return of 15%, including dividends. Amcor seems to have a relatively favorable valuation. That's, of course, a lower price due to the uncertainty. You see a price to earnings ratio for next year below 15. Compared to the sector median, that's quite a big difference. Other ratios look okay. For example, price to sales. The price to book ratio is indeed on the very high side. And this is still a capital-intensive company, so here a review of the balance sheet is needed. The dividend yield is currently 5%, and look, at the market value, 14 billion is about 8 billion in debt. As a result, the enterprise value also comes out above 21 billion. Pay close attention to debt. That debt needs to be paid off. We saw that here too. They sold part of it to pay off debts. But it's crucial to understand what's going on here. And does that possibly present an opportunity? Yes or no? So actually, it's more of a value stock than a high dividend stock. But that's beside the point. The dividend yield for next year is estimated to be around 5.2%. The payout ratio is a bit on the high side, with 70%. And yes, it's not really a superior dividend house stock. However, since they started paying the dividend, they have done so for 5 consecutive years, with some degree of dividend growth, although it's not a whole lot. But yes, it's already a high dividend of 5%. The 6 rating, however, indicates a sell rating, so they are less enthusiastic about it. But if we look at technical analysis, we see that after a recent decline, indeed the stock is currently in a negative trend. It has fallen by about 18%, according to about 15%. Buying in a negative trend has often not worked out well for me, especially when there's a lot of uncertainty, so be careful with this. What could be interesting, just simply adding Amcor to your watch list and seeing if it drops to the level of 8.5. It can drop. That would mean a serious decline of about 12% further. That just means that the margin of safety is increasing. If you know the company much better than the market crowd, then there are opportunities. But I don't know the company well enough to make a judgment about that. Brutal. Milk and tobacco. We've mentioned the dividend stock several times in one of our dividend analyses. If you like our analysis, then subscribe. Then you'll automatically stay updated on new stock analyses. So we'll go through this cheerfully. Brutal. Milk and tobacco with the ticker, BTI. It looks promising. The fair value estimate from Morningstar is 50. That's significantly above the current price. That's why they give it a 4-star rating. And they also indicate that this company has a strong cultural example. However, there are some concerns about the growth prospects. Of course, it's also not a very popular sector that this company is in. However, if we look at the historical valuations, we see a growth in profits at the bottom line, and the price has dropped to a relatively low level. So that means there could be potential value in it, with a bit of margin of safety. But for that, you need to know the company and the sector better to determine, is there still long-term growth in this sector? That is not very desirable. The price of Unix has dropped to a very low level, but the normal multiple is also around that level. So this seems like a good and realistic valuation. If the company BTI achieves a bit of BPS growth, namely about 5% earnings per share growth, then we'll keep the same multiple. 8.5 means a potential return of 15%. Is it realistic? I think so. The factor that has led to a buy could be that it might soon turn into a strong buy as momentum increases. And you see the valuation numbers look relatively good. The dividend yield is 8%. We're seeing shocking things. Well, yes, total debt is again quite high. So this company also has high debts. These are things you need to take into account, especially if you have a lower risk profile. Dividend yield. We've talked about 8%. Let's take a look at the historical payouts of BTI. They actually pay out cents every quarter. 2 years of dividend growth, and they have been paying out dividends for 14 years. I don't see many special things. However, Zex indicates that they consider it a sell, but there is no good justification for why. So there's really no reason to assume that. Now the stock has also risen a lot recently. We've mentioned BTI before, and yes, back then the price was even better. The valuation. Now suppose it's not likely, but suppose it drops again by 16% to this level, then that seems like a more interesting entry point. We can really see at the bottom that the MACD has turned negative and it's starting to drop. So it could be that the moment in which we indeed decreases, maybe down to the price level of 34, that means a marginal decrease. And also down to the same price level of 34, which was in November 2021. What is the potential? Well, you see it has dropped enormously. No idea why. BTI was valued so high in 2017, dropped by 50%. So then this is really just pure a price chart. I don't want to say anything. Please look at the fundamentals. BTI seems to be cheap. It seems to pay out a high dividend, but what the growth prospects are, that's of course up to you to decide further. Maybe the most interesting one on this list, in terms of high dividend stocks, the company Iteran Location and Control with the ticker ITRN. This is also a smaller company, not really well known. Few analysts cover it. So there could be some significant price gains to be made here. Morningstar gives a fair value estimate of 30, while the current price is 33. But I wonder if they've really looked into this properly. Well, they indicate that the economic moat is narrow, but that's probably based on their algorithms. The analysts covering it, there are only 2, give a price target of 36. I'm more inclined to believe these kinds of numbers. Why? Because when we look at a historical valuation, we see an interesting growth from this company, Ituran, which could mean that they might be undervalued at the moment. That means when we look at the forecasting, adjusted with the normal multiple and the EPS growth that we see below, we still see an interesting growth estimate for the longer term, and that means that the potential return could be 1% per year. Now, of all these stocks, this one seems to be the most interesting from this video selection, but in other videos like those about small cap stocks or the best stocks, for 2025 we've provided a lot of analyses on stocks that might have an even better and more attractive profile, so don't just rely on the paid out dividend. Sometimes you just have to invest in companies with a lot of growth potential. Because then after, for example, 1 or 2 or 3 years, you can just cash out a part, and you can consider that as your dividend. The same principle, but a different approach about investing. Why is eToro so interesting? Well, the valuation is still relatively low, especially compared to the sector. Median, we're not seeing anything shocking. Price to sales is okay, the book value is a bit on the high side, but price to cash flow is under 10. That's usually a bit more favorable. The dividend yield is 4.6%. We also don't see any particular issues regarding debt. Actually, they have almost no debt, so that's worth mentioning. The market cap is still relatively small, so this is a small cap company. Once again, also check out our analysis on small cap stocks. 7 amazing small cap stocks that you probably have never heard of. And all 7 of them can really pay off in the long term. That means investing 1,000 euros of your wealth could turn into 10,000. It could very well happen with small cap stocks. And maybe Utrend is one of them. Although I doubt that because they do pay out a lot in dividends, so it's not really a good company. And stocks that pay out a lot in dividends, of course, don't perform well in terms of price return. Super tough. Unless, of course, you reinvest the dividend and keep reinvesting, then you can achieve very high returns. The dividend yield is estimated at 4.6%, payout ratio under 60%. In terms of consistency, and it's not superior, as we can see. And regarding current developments, we suddenly see a rapid price increase, probably based on quarterly figures and news. Increased by about 25%. The all-time high is in sight, namely at a price level that's quite a bit higher. So it could very well be that it breaks through that all-time high. But the question is, what happens then? And what is interesting to investigate and follow with this company, if it breaks through the all-time high, then, at least from a technical analysis perspective, there's no longer a psychological barrier, and the company can rise even further. Because the most important thing is the fundamental development, and we see the luck ratio of just under 1, slightly below 1, and that might mean it's slightly undervalued for the next 5 years. That's the question. Interesting stock, but research is needed. Finally, for inspiration for further research, is the latest high dividend stock, New Lake Tippitop Partners. This is a specialized real estate fund in cannabis. I personally wouldn't invest here, but I can't judge for you what is or isn't interesting. But a real estate fund in cannabis can obviously do very well or very poorly. A special focus in a niche can turn out well or poorly. There are 2 analysts who have covered this stock with the ticker NLCP, and they believe that there is a great price potential to be gained, namely about 40% on average, but there are only 2 analysts. So it's much better, gentlemen, to do your own research anyway. What is always the best choice? This stock may be undervalued based on the historical data. It's a REIT, so we're calculating with the price assigned deviation. Because the price has recently dropped, the price AFVO is only around 8. That's quite low. Around 8. That's really quite low. Now consider the EPS estimates below, or being realized. I have to say AFVO is good, then it's actually a minimal growth of about 1%. Those are low expectations. So, the lower the expectations, the easier it is to exceed them, of course with some positive growth. So there could still be some upside potential here. But because that price is sometimes so low, 8. And let's say they stay at the same level, 8.2 over 3 years. Still, the return seems attractive. An average return of 11.6%, how is that possible? Well, simply because it is. A real estate fund pays out a very high dividend of about 10%, but that 10% can only be maintained if they continue to make a profit. And ideally, you want companies that achieve profit growth because that provides more certainty for high dividend payouts. So even for high dividend stocks, you always need to look closely because it's a strong company, because you want the company to make more profit in the future. So your dividend certainty rises ideally with dividend growth too. Increases, and preferably, of course, with dividend growth. So pay very close attention to that. But if you look at the valuation, it seems super cheap with a price drainage of 8. That's a lot lower than the sector. Median, there are indeed some specifics, and that is mainly the niche. However, it was noted here that he has almost no debt. That's quite remarkable for a real estate fund. But the biggest risk is the niche allocation in cannabis. It could also be the biggest opportunity for this stock, so you really need to pay attention here. Do further research. The dividend yield for next year is estimated at 10.4%. The payout ratio is, as usual, high for real estate funds. When it comes to dividend consistency and growth, there's not really much to report. Well, they have paid out dividends for 3 years in a row, and they aren't on the stock market yet, so they're doing that well. Centric has dropped a lot. Since the IPO, it has even dropped by as much as 60%, and the current price is down 45%. Well, you can see a clear downward trend. Here, we don't need to be Einstein for that. So what would be interesting, that this downward trend continues. And it drops again to this former price level of 12. I don't want to say that it's the ultimate buying moment. I just want to say that it could be, based on technical analysis, that a support level is forming there. Only crucial conditions. If that happens, at that moment you need to reevaluate. Is the company still in good shape for the future? And that is, of course, the crucial question for New Lake Capital. It pays out a high dividend. So this was for inspiration, the last high dividend stock on this list. Maybe in potential. One of the better ones precisely because the expectations are so low. but high risk. And I wonder if you also want high risk with the strategy of high dividend stocks. So, how can you deal with that? Always when the risk profile is indeed higher, the potential gains can be very attractive. Does that mean you want to make an asymmetric investment? High risk means putting a lower percentage of your money on it. Betting. If you have a pot of field, you want to bet a smaller percentage on it. The same goes for everything. Like crypto, good and carry it. Outside of our real estate, I just call them small cap stocks. And so, for example, also for this high dividend stocks, instead of investing 5% per dividend stock for high risk, you can also invest 1 or perhaps 2% in dividends or percentages, for example, only if you believe in it because you think there might be something to gain. But keep in mind, it can also go the wrong way. It is about high dividends stocks. Of course, follow us for more updates on stock analyses within our tools. Just purely for inspiration and entertainment. There are often winners among them, so I hope you can enjoy it. But be careful, with money you can always lose your investment. I hope not. So always be wise with what you do. If you have questions, let me know. And also, do you have any special insights about certain companies or that you might want to investigate? Have shown, let me know. I'm trying to take them along in the next series. Thank you and see you next time.